Welcome to GRE. I'm your host, Keith Weinhold. Learn how rent inflation makes real estate investors wealthy. Do certain grocery stores in your neighborhood stoke real estate prices? Then, how just $1,000 of extra monthly cash flow can be surprisingly life-changing. Today on Get Rich Education. Let me ask you something. If you've worked hard to build wealth, is your money positioned to actually support your goals? A lot of accredited investors leave capital sitting in cash because it feels safe, but inflation and missed income opportunities can quietly erode its value. Freedom Family Investments offers Freedom Notes for investors seeking structured income backed by real estate. It's a straightforward approach built on real assets, not speculation. And full disclosure, I'm an investor myself. What I like is that their team walks you through how it all works so you can decide if it aligns with your portfolio and income goals. Every investment carries risk and nothing is guaranteed, but with a track record of consistent on-time investor payouts, they've built real credibility. Go to freedomfamilyinvestments.com to book a clarity call or text FAMILY to 66866. That's FAMILY to 66866.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. I'm your host, Keith Weinhold. It's the show that coined the phrase, real estate pays 5 ways. This is Get Rich Education. You learned how to work at your job. The reason we're here is to make you aware that capital compounds, labor doesn't, and that's almost why you have to be an investor today. A couple weeks ago, we had Tax Day in the USA, and that's not quite a holiday. Virtually no one celebrates it. Yes, here in our 250th year of existence as a nation, that erstwhile mentioned semi-quincentennial. How did America go from fighting a revolution over a 2% tax on a breakfast beverage at the Boston Tea Party to what we pay today? Have you really processed what this has come to? Now, we're taxed when we earn money, taxed when we spend it, taxed when we save it, taxed when we invest it, even taxed when we die with it. And that's just the start. Think about your typical day, your routine. We commute to work in a car. We're taxed to register. Driving on roads, we're taxed to build. Fueled by gas that's taxed again. And then often paying tolls on top of that. Well, those taxes are supposed to maintain the infrastructure like bridges, highways, and tunnels, but yet they already have billions of taxpayer dollars allocated to them. Then we arrive at an office that's taxed to exist, inside a business that's taxed to operate, that requires permits and licenses that act like other layers of taxation. When we finally get our paycheck, our employer matches payroll taxes on top of our wages. Just incredible. And at the end of the day, we go home to a property we're taxed to own every single year, purchased with income that was already taxed in the first place. And somehow all of this is considered normal. Here's the turning point. Most people, when they realize this, feel frustrated and saddened and even victimized. But instead, real estate investors flip the frame from victim to strategist. The same system that taxes seemingly everything quietly rewards those who own assets. Through depreciation, we report a loss even when the property produces real cash flow. Last week, I told you how you can specifically lower your property taxes step by step. Then, through mortgage interest and operating expenses, we can reduce that amount of our income that's even taxable at all. Through long-term leverage, we're often repaying debt with inflated dollars while our tax burden stays surprisingly low. And then it gets even more powerful. More advanced real estate investors use a cost segregation and bonus depreciation to pull years of deductions forward into today. And it's something that's not really that sophisticated or tough to understand either. And then when we sell a property, 1031 and 721 exchanges help us defer the capital gains tax. And when you start to think about it, could these turnabouts even get us patriotically excited for a, dare I say, semi-quincentennial? Our system of taxation, it can feel punitive. Some high earners lose more than 55% of their income to taxes, both federal and state. Real estate investors don't just earn gains in income. We reshape it. We continue to thrive in a tax system that rewards ownership. Not only is wealth built from owning things rather than having a high salary, tax breaks are gained by owning things rather than having a high salary. And now it's somewhat common knowledge that war leads to inflation. The latest Middle East conflict entails a lot of military spending, and it's been made worse by disrupting an energy-producing region. 4 weeks ago, I told you about why wars are inflationary and just how bad it can get. That is why the first major wartime inflation reading that we got was so telling. And wow, inflation grew at the fastest annual rate from 1 month to the next since the pandemic spike back in 2022. It went from 2.4% up to now 3.3%, just like that, and with more inflation poised to come along, even if the war winds down. And I want to talk more about how this benefits you shortly. And yes, if you're a newer listener, you're not used to inflation benefiting you, but it benefits the educated and the aware GRE listener. And first, here's what fewer people pay attention to. M2 money supply, that's jumped 4.8% annually to a record of almost $23 trillion now. The money supply. This is the 24th consecutive monthly increase. The supply was only about $5 trillion back in 2000, $10 trillion by 2012, $15 trillion in 2020, and then the pandemic made the money supply explode, and it's almost $23 trillion today. And what does this all mean? That the US dollar is losing purchasing power at a historic pace. Because look, inflation is actually not rising prices, the thing that's now up to 3.3%, the CPI. Rather, inflation is an expansion of the money supply. It inflates. That is the very etymology of the word. People often overlook that. That's why I'm talking about the historic expansion rate of the money supply and how that can show up in higher prices later. High prices are not inflation. Rather, they are a consequence of inflation. And I want to tell you more about what this means to you and explain how this builds your wealth in a new way. But first, my gosh, have you been as flabbergasted about inflation as I am, just at the consumer shelf and aisle level in a store? And I'm a guy that likes to spend money, yet I've got to say, sticker shock, it still gives me pause when I'm in a store, even on the cheapest of items. I recently went inside a gas station convenience store after I filled up. A regular size York peppermint patty, 1.4 ounces, cost $3.19. This consequence of inflation has left me slack-jawed. But I already was a slack-jaw. However, has it left you slack-jawed? All right, let me tell you about how the wildly overpriced York peppermint patty makes real estate investors rich in their sleep. Did you know that the classic economist Milton Friedman discussed the concept of Get Rich Education's inflation triple crown, essentially? Now, he didn't call it that. In fact, he discussed it before GRE existed in 2014. Let's listen into this. Friedman won a Nobel Prize in 1976. I'm going to guess that this is him speaking in about 1980. Essentially, he discussed the first two crowns, which are also the ones that homeowners with a mortgage benefit from, which are asset price inflation and debt debasement. This is about 2 minutes in length.
If I ask people, are you in favor of inflation or not? Everybody's against inflation. But when I explore a little bit further, if I say to people, tell me, have you gained from inflation? Oh, no, you say. I haven't gained. And yet the fact is that a great many people have gained from inflation. There are many, many people who have benefited. Of course, the major gainer from inflation is the Federal Treasury, as I've already said. But almost everybody who has bought a home in the past 30 years has gained from inflation. He was able to borrow on a mortgage, which inflation has paid off along with paying off the government debt. So that almost all homeowners in this country are beneficiaries from inflation. Indeed, one of the things that makes inflation such a bad social disease is precisely that it tends to be divisive. Because some people do very well during an inflation period, and some people do very badly. And as a result, the population gets split into people who are seeming in great prosperity and people who are in great distress. When most people say they want to stop inflation, what they mean is that they want the prices of the things they buy to go down and the prices of the things they sell to go up. But since what one man sells is what another man buys, that's a neat trick if you can do it. And as a result, people aren't really serious when they say they want to stop inflation. Certainly not in the early stages, not before they fully understand, not before it's gotten to the point where it is really creating serious social problems. Everybody wants to stop inflation at somebody else's expense.
That was classical macroeconomist Milton Friedman discussing the rarely talked about benefits of inflation. He also served as an advisor to President Reagan and to British Prime Minister Margaret Thatcher. Friedman extolled the virtues of free markets and minimal government intervention. Well, yeah, he discussed the first two crowns of Get Rich Education's Inflation Triple Crown. So let me discuss the third one, because you benefit from this when you rent out property. And what's interesting about what I'm going to tell you is that this example is going to make it more apparent than it ever has to you that rent inflation makes landlords rich in their sleep. In fact, the positive effect on you is even greater than I thought. I double-checked these numbers I'm about to share with you before I came on the air because I didn't expect this high of a degree of cash flow enhancement. And also, I was talking about what I'm going to show you on YouTube earlier, and it generated a negative biting comment from a viewer. I'll tell you about that. But yeah, I showed this to a guy that's been investing in real estate for 36 years, and he didn't even understand this. Here it is. With general monetary inflation, rent inflation is a consequence. So let's keep this simple. Say that you charge rent of $2,000, and that could very well be a realistic rent amount for a single-family rental property that our GRE investment coaches help you find today, although the average is probably a little less than that. So in any case, $2,000 rent. When you subtract out your fixed rate mortgage payment of $1,000 and your operating expenses of $800, this leaves you with $200 of monthly cash flow. We'll say that's your scenario today. Next, rents rise 3%. This means you're getting $2,060 now. Doesn't sound so exciting yet. Your mortgage payment stays locked in at $1,000. Inflation can't touch it. That's the key to this. Your operating expenses also rise 3% up to $824. This leaves you with cash flow of $236. Okay, so what happened there is your cash flow went from $200 up to $236. That's not a 3% gain. Inflation gained 3%. This is an 18% increase in your income, $200 up to $236, an 18% cash flow spike off just a tiny rent adjustment. Well, extrapolate that effect across your portfolio. I mean, this is like your annual income going from 100K up to 118K and then compounding like that every single year. That is power because inflation couldn't touch your fixed mortgage payment. And this is something I've explained before. It's the third crown of Get Rich Education's inflation triple crown called cash flow enhancement, but it's a better example than I've ever had for it. And it's a germane time to talk about it with inflation on the rise again. Now here's an angle. Does what I just explained feel wrong in any way? The thing is, you aren't fleecing your tenant. It's just an adjustment to inflation, a little 3% bump to them, a big 18% difference to you. You didn't get rich off your tenant. You got rich because, again, you're leveraging the bank's money, but you're doing it in a way that most people don't see or think about. And of course, mortgage-free owners lose this entire benefit. It is just another way that real estate investors get rich in their sleep, yet few ever understand how. But like I said, I was talking about this on YouTube just a little bit ago, and a commenter simply wrote, "This makes you a bad person." Now, the viewer of GRE's YouTube channel, sometimes it's you, but sometimes it's someone that doesn't listen to this audio show here where we do more learning. The casual or occasional YouTube viewer, they just probably don't understand all of what you do. But yes, like me, you have probably run into people out there that think that landlords are bad because they charge tenants rent and they adjust the rent as their expenses rise. And some of these people even say something like, "I believe housing is a human right." I seem to hear that more and more. Okay, that's one thing, but they imply that the taxpayer should pay for their housing. I mean, does that even work? Over time, you can see how often government-provided housing fails and it ends up being exorbitantly expensive when the free market prevails instead. I think that this sentiment has gotten a little worse because of the K-shaped economy. More people having to sleep in their cars makes those people resentful. America, we're in better shape when we have a strong middle class. What can really help you a lot is, if you haven't yet, finally watch the 3-part video series, The Inflation Triple Crown. The video really helps reinforce your learning well because it's helpful to show numbers on screen like you can in a video. You can watch that directly by going to getricheducation.com/inflation triple crown, or shorter, you can just go to the abbreviated getricheducation.com/ITC. It takes you to the same place. It really shows you how to optimize your income increases and do it the right way. I mean, if someone thinks you're a bad person for raising the rent 3% commensurate with 3% inflation, well, you know what? Then if that person is an employee, should they also feel bad for getting a 3% pay raise at work? Well, then they should, right? Because they're charging their employer 3% more for their services as an employee. Well, of course that's okay. So that sentiment doesn't make one bit of sense. All right, well, let's temper the 3% rent inflation that I used in our example here. There's both bad news and good news around this because today, rent increases are below average nationally. In fact, Zillow has forecast only a 1.1% rent increase in single-family rentals this year. And then the good news is that the average rent increase since 2020 is 6%. And we only used 3% in our example. The bottom line here is that few real estate investors ever have the epiphany that cash flow enhancement is yet another significant way that inflation makes them wealthy. And it's just another reason why carefully selected, simple buy and hold residential real estate makes people wealthy. Just buy and hold. You don't have to dig in and do a bunch of aggressive value add or get into a niche like self-storage or short-term rentals or assisted living homes. Now, you sure can do those things, and there's nothing wrong with niching down. You just don't have to. And sometimes we even discuss those niche vehicles here on the show. In fact, we've done 4 episodes on assisted living homes. But it's hard to beat the relative passivity and the durability of simple buy and hold residential. Not the latest hot thing, not speculation, but just what's proven. But you have to understand these forces and then act on them. I mean, I gave an example there of $200 in cash flow. And since that's only the most visible component of the 5 ways real estate pays, when you add it all up, you might be getting $1,500 of monthly benefit on a single-family rental property that only costs $300K. $1,500 a month on a $300K property that you might have only put 20% down on. And for that $1,500 a month, it might only take 1 hour per month of your asset managing of your property to get that $1,500 of benefit. So that is $1,500 an hour. That's great, but it's only 1 hour a month, and that's exactly what makes you want to scale with buy and hold property. As soon as you get into a lot of real estate niches, which again, it can be worthwhile, whether that's self-storage or assisted living homes or something like that. Well, now it's more like an active business that you have to run, and you're probably going to spend substantially more hours there. But yes, a guy that's been investing in real estate for 36 years did not understand cash flow enhancement from rent inflation until I showed this to him. And watch it all. He watched the 3-part video series, which again, you can watch for free at getricheducation.com/inflation triple crown, or shortened, simply getricheducation.com/ITC. Open it up now and watch it later, because I'm back with more next. I'm Keith Weinhold on episode 603 of Get Rich Education. Flock Homes helps you retire from real estate and landlording, whether it's one problem property or your whole portfolio, through a 721 exchange, deferring your capital gains tax and depreciation recapture. It's a strategy long used by the ultra-wealthy. Now, mom and pop landlords can 721 their residential real estate. Request your initial valuation. See if your properties qualify at flockhomes.com/GRE. That's FLOCKhomes.com/GRE. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
What's up, everyone? This is HGTV's Tariq El Moussa. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. I'm here in Las Vegas today and staying at the Bellagio with a terrific fountain view room. Yes, the paradox of having a giant water show every 30 minutes in the middle of the Mojave Desert, as it is. Today, just up the street at the Venetian, the big Bitcoin 2026 conference kicks off. I might attend some of the sessions, and I might not. While I'm here in Vegas, I'm more focused on spending time with my brother's family. I know I've mentioned to you before that they live in nearby Henderson, Nevada, and I come here pretty often. You could call me a real estate investor that's crypto curious. I own a little Bitcoin because I think it has some compelling value propositions, as well as a number of problems. I think, like a lot of people, I have more questions about Bitcoin than I do answers. And each time I get a new answer, it just prompts 3 new questions. Now, I plan to shop at Trader Joe's shortly. I'm kind of a weirdo here in Vegas in the sense that I don't gamble, and rather than eating every one of my meals out, I like to be a little healthy, shop at a grocery store, and bring good food back to the fridge in my room. Well, how do certain grocery store chains impact local real estate prices? And you might have heard about this before, but there's a good news study about it that just appeared in the USA Today. And I kind of like the USA Today because you can easily find a USA Today article where a columnist wrote a story about me as well. But what happened is an analyst matched more than 32,000 store openings to property prices over 50 years. And one conclusion found that homes in the same zip code as a Trader Joe's saw their values rise about 6% faster than the national average over 3 years. Another study found that over 5 years, home prices near Trader Joe's rose by 49%, compared with 45% for homes near Whole Foods and 58% near Aldi. I wouldn't have expected that. Aldi is a low-cost bargain grocery store. Now, there are a couple twists here. First, a higher-end grocery store like Whole Foods, that might very well correlate with a good, more affluent neighborhood, sure, but it also might reflect the fact that home values are high, and that usually is not profitable for long-term rentals. And the other takeaway is that grocery stores don't actually cause price appreciation. Instead, they reflect it. These grocery chains, they really invest heavily in site selection, so their presence signals that an area was already trending upward. Even before a Trader Joe's arrives in an area, the median household income in a neighborhood hovers around $82,000, and that was the highest in the chains that were studied, with a typical home value of $425K. And the flip side is also pretty noteworthy. The study found that Walmarts tend to be built in neighborhoods with an average household income of only $49,000 and home values of under $200K. Plus, the home price appreciation proximus to a Walmart, it ends up trailing the national average by 4% over 3 years. So really, can we say then that the K-shaped economy runs through the grocery aisle? I want to get back to discussing your wealth shortly, but first, let's have a checkup on the economy that you're invested inside every day. Over the past year, the U.S. economy has continued to do well, which has surprised some people, some saying that the economy seems to defy gravity. I mean, look, at this point, it has withstood chaotic tariff changes, labor supply shocks, swings to the stock market, and then a kinetic war on top of that. And how is it pulling this off? Probably starting with AI investment, including all the data center building you see taking place, technology innovation, and a consumer that, it's funny. All these consumer surveys where the consumer feels negative, probably because they keep seeing higher prices, but yet even though they feel negative, they just keep spending more anyway. The unemployment rate is still really low. The AI build-out is significant, and that drives jobs and rents and incomes. Realize, though, this is a new infrastructure build-out. This is substantial, just like railroads and the internet were. And companies racing not to fall behind in the AI boom, that's exactly what fuels the economy and productivity, and therefore supports real estate. It's similar in spirit to the dot-com boom, really, but this time there's real revenue, and it all fuels wage growth, which is an antecedent to rent growth. And by the way, have you ever noticed how economists and corporations, they're so addicted to growth and the notion of growth that if something goes down in value, they call it negative growth. What is negative growth? That's always been a funny phrase to me. Don't you mean a decline? Negative growth, that's kind of like calling growth a positive decline. That's nonsense. Some people are allergic to saying that something is a dip or decline, so instead they say that it's negative growth. And that's sort of like how companies, they don't want to say that they're undergoing a round of layoffs. Instead of layoffs, they say that we are right sizing. Sheesh, just tell it like it is. Now, when it comes to building your wealth, say that you're more of a beginning real estate investor. Say that your income from your job is $100K. And you might wonder, if I add, say, 5 properties, each with $200 a monthly cash flow, that equals $1,000 a month. That's an extra $12K per year. That really isn't that much of a lifestyle difference. Even though there are 4 other ways real estate pays, let's just talk about this. That's only $12K per year on top of $100K. I contend that really does make quite a difference. Okay, if your real estate cash flow gets up to $1K a month, and you might only spend 4 hours a month managing that, it matters more than you think, because of your $100K of job income, all right, after all your expenses are taken care of, like you pay for your housing, your transportation, your Trader Joe's groceries, all of that stuff that you spend on, well, what's left over, your discretionary income, that might only be $2,000 per month. So if you add $1,000 to that, that is a 50% increase in your discretionary income. What really matters? That's why real estate cash flow is actually a bigger deal than a lot of people think. You just bought back your time. This can help you replace a second job. This can let you cut back hours or even fund a sabbatical buffer. For beginners, that's why even a kind of paltry sounding $1,000 a month in cash flow from, say, 5 rental doors, that can actually be a life changer when you get right down to it. It really starts to change your control over your time. And an extra $1,000 a month can, of course, help fuel your next investment if you so choose. But that's not all. A psychological shift begins to happen inside you. You're no longer dependent on one income source. This is really the underrated one, because before $1,000 of real estate cash flow, a job loss, that could mean stress and urgency and bad decisions. But afterward, now you have margin. Now you're making better decisions in life. You negotiate better. You think longer term. That shift alone improves your entire life. And what else can just $1,000 a month do for you? An extra $1,000? It can give you lifestyle upgrades without guilt. Let's say you do spend some of it. That can fund travel without touching savings. That can give you better housing or a better location. That can give you experiences instead of a life of what feels like just bills. And here's the key. It does not cannibalize your future. Just $1,000 a month gives you options. Like we say around here, don't live below your means, grow your means. I mean, if you're a beginner, this is something that you could have in less than a year. That extra $1K, that comes whether you work that day or not. And for a more advanced investor, you can imagine what multiples greater than $1K per month do. So can you see how everything compounds here? Capital compounds, labor doesn't. Earlier, I discussed how even a 3% rent bump can increase your cash flow 18%. All right, and then your cash flow has a greater impact than you thought because it is discretionary income, where a small change can make a world of difference in your life. And when you layer all these things together, it almost makes you wonder why more people aren't real estate investors. Well, most people just have not had it explained to them this way before. And then other people give up after starting in real estate because they don't buy the right property in the right market. Here at GRE, we really help you avoid those mistakes. And in fact, let me give you an example of what I mean. This can really help. Redfin reports that national home prices have jumped up again, rising 2.1% annually. But yet a place like Florida, they still have year-over-year housing price declines, not negative growth, declines. And that's due to a temporary overbuild like I've talked about before. But Cape Coral, Florida homes, that area has been hit harder than most with more building than most places. They're actually down in price 3.8%. It looks like an opportunity, and people say they want an opportunity. What they really want is certainty, and once certainty arrives, the opportunity is gone. Winners often embrace the heterodox. They're willing to lean into the sort of uncomfortable, mildly contrarian, awkward moment right when others are hesitating. Some Florida brand new property builders, they're getting creative, and the translation to creative is that they are motivated. They're offering to throw in the kitchen sink and the backsplash. Here's one example, a duplex in Cape Coral, Florida. The listing price is $550K. It's in an A-class neighborhood. The rent is $38.90. Both sides of the duplex are already leased. 6 beds, 4 baths. It's 2,474 square feet. The down payment you can expect to make is 25%. The projected cash flow is up to $1,096 per month. Yeah, you've potentially got your surprisingly life-changing $1K in cash flow in one fell swoop here. And here's where it gets interesting. A 3.75% mortgage rate buy down and 1 year of free property management. They're either giving you that or take $25,000 cash instead and structure your own advantage. All right, that's what this certain builder is offering now. A reputable builder. In fact, they've been a guest on the show here before. You can push the envelope a little further than that. I encourage you to make an offer below the list price on these property types. Yes, offer lower than the $550K. How much lower should you go? That's where a free chat with our investment coach gives you an inside edge, because see, they know what other offer amounts were accepted previously by these sellers. So they know where the real flexibility is, and they've got all kinds of what I'll call specific deal knowledge like this that you're just not going to find anywhere else. Our coaches can also help you with other inventory if it better meets your personal objectives than something like a Florida new build duplex. Usually those places are in the Midwest and South, from Ohio out to Missouri and Georgia out to Texas. In full disclosure, what I just described is a better deal than any Florida properties that I personally own myself now. It is clearly a buyer's market in Florida. We're in that fleeting window where long-term demand is strong, short-term supply is high, and builders are motivated. So take the free consult, or maybe no properties are right for you once our coach learns more. If you're interested, we can help you structure a smart offer. Talk to us. We can help you build an entire portfolio if you so choose, and find the right markets and properties with a management solution. We've got the team and the contacts. You can make your process easier than guessing and figuring it out on your own. I often like to leave you with something actionable at the end of the show. I encourage you, if you think it's right for you, book time with a friendly GRE investment coach at greinvestmentcoach.com. You can find an open slot on their calendar and book it again at greinvestmentcoach.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.